Something changed last week, not in the headlines, not on the front page of the financial press, but in the data that matters. Silver reserves held by major exchanges dropped 15% in a matter of days. That's not normal volatility. That's not market noise. That's a structural shift in available supply at a time when demand is already stretched. If you've been following the silver market for any length of time, you know that moments like this don't arrive often. And when they do, they're rarely announced with fanfare. This video isn't about predicting the future. It's about understanding what's happening right now, why it matters, and what it means for anyone who takes their financial future seriously. Whether you already hold silver or you've been watching from the sidelines, what's unfolding deserves your attention. Not because of hype, not because someone told you to panic, but because the fundamentals have shifted in a way that changes the probability landscape for this market. Let me walk you through it. Over the past several weeks, physical silver inventories reported by major exchanges have declined sharply. We're talking about COMEX warehouses, London vaults, and major ETF holdings all showing drawdowns at the same time. A 15% drop in available reserves doesn't happen in a vacuum. It reflects real demand meeting constrained supply in a market that's already been tightening for years. Now, let me be clear. This isn't the first time we've seen inventory declines. Silver markets have cycles. They have seasonal patterns. They have periods of accumulation and distribution. But what makes this moment different is the context. We're not looking at an isolated event. We're looking at a convergence of factors that have been building for years, all reaching a critical point at the same time. Industrial demand for silver continues to grow, driven by solar panel production, electric vehicle components, and technology infrastructure that requires physical metal, not paper contracts. This demand is structural, not speculative. It doesn't disappear when sentiment shifts. At the same time, mine production hasn't kept pace. New silver mines take years to develop. Existing mines face higher costs, regulatory challenges, and declining ore grades. The easy silver has already been extracted. Meanwhile, investment demand has been quietly accelerating. Central banks around the world have been diversifying away from dollar-heavy reserves. Sovereign wealth funds are looking at hard assets. Institutional players who ignored precious metals for a decade are now asking questions. And then you have the monetary backdrop. Let's talk about what's driving all of this from a macro perspective. Since the financial crisis of 2008, global debt has more than doubled. Governments, corporations, and households are carrying record levels of debt in absolute terms and as a percentage of GDP. When debt reaches these levels, there are only a few ways out. You can grow your way out, which requires productivity gains and economic expansion. You can default, which causes systemic collapse, or you can inflate your way out, which erodes the real value of debt over time. History shows us which path gets chosen. Central banks have spent the last 15 years expanding their balance sheets, suppressing interest rates, and intervening in markets to prevent disorderly deleveraging. The Federal Reserve, the European Central Bank, the Bank of Japan, all of them have followed the same playbook. Even when they talk about tightening, even when they raise rates or slow asset purchases, the underlying trajectory hasn't changed. The system requires more liquidity, not less. The debt burden demands it. And here's what most people miss. When you create currency at this scale, when you suppress the cost of borrowing for this long, you don't just inflate asset prices. You change the incentive structure of the entire economy. You punish savers. You reward borrowers. You create distortions that ripple through every market. Precious metals exist as a counterbalance to the system. They're not yield-bearing assets. They don't generate cash flow, but they're also not someone else's liability. They can't be printed. They can't be digitally created with a keystroke. In an environment where currency debasement is policy, hard assets start to look different. Not as speculative plays, as insurance. The financial media tends to frame precious metals as relics, barbarous relics, as the famous phrase goes. They'll tell you that silver is just an industrial metal, that it's too volatile, that it doesn't fit into modern portfolio theory. And in a world where everything is financialized, where every asset is measured by its sharp ratio and correlation to equities, that narrative makes sense, but it misses the point entirely. Silver isn't trying to outperform tech stocks in a bull market. It's not competing with high-yield bonds for income. It serves a different function. It's a store of value in a system where value is being systematically diluted. Most investors don't think in those terms because they've been trained to optimize for returns within the existing financial framework. They look at charts. They follow momentum. They chase performance. Nothing wrong with that approach when markets are functioning normally. But we're not in normal times. We're in an era of unprecedented monetary experimentation, fiscal deficits that would have been unthinkable 20 years ago, and geopolitical tension that's fracturing the global financial architecture. In this environment, the assets that seem boring or outdated to the mainstream can become the most important pieces of a portfolio, not because they're going to the moon, because they provide stability when everything else is unraveling. Let's look at how markets have behaved in similar conditions. The 1970s are the most commonly cited parallel. Inflation accelerated. Confidence in fiat currency weakened. real interest rates turned deeply negative, and precious metals went through a decade-long bull market that shocked the financial establishment. Silver, in particular, moved from under $2 an ounce to nearly $50 in a span of 10 years, not because of speculation alone, because the fundamentals of the monetary system were breaking down. Now, I'm not saying we're going to see an exact repeat. History doesn't work that way, but the pattern is instructive. When currency loses purchasing power faster than expected, when debt becomes unsustainable, when trust in institutions erodes, people look for alternatives. They always have. Gold and silver have served that role for thousands of years. Not because of tradition, because they work. What we're seeing now isn't identical to the 70s, but the underlying dynamics are similar. Massive debt, persistent inflation, central banks trapped between fighting inflation and supporting markets, currency devaluation as policy. These conditions create an environment where hard assets re-rate, not overnight, not in a straight line, but over time, with conviction. Let's get back to the immediate issue, supply. When inventories fall 15% in a matter of weeks, it tells you something about the balance between available metal and immediate demand. Think about what that means in practical terms. Exchanges hold physical silver as backing for futures, contracts, ETFs, and other financial instruments. When those inventories decline, it suggests that physical metal is being withdrawn from the system, either for industrial use, investment demand, or delivery against contracts. This doesn't happen because people are speculating. It happens because someone needs the actual metal. And here's the critical part. Silver isn't like oil or copper, where new supply can come online relatively quickly if prices rise. Silver production is largely a byproduct of other mining operations. Most silver comes from lead, zinc, and copper mines. You can't just increase silver output without increasing production of the primary metal. That creates a structural constraint. Even if prices rise significantly, even if mining companies have every incentive to produce more, the supply response is slow and limited. Meanwhile, industrial demand isn't price sensitive in the way consumer goods are. If you're building solar panels or manufacturing electronics, you need silver. You can't substitute it easily. You can't just decide to use less because the price went up 10%. That creates inelastic demand meeting inelastic supply. And when you add investment demand on top of that, the equation becomes very tight. If you've been holding physical silver for months or years, watching the price go sideways while the world seemingly moves on, you might be wondering if you've made a mistake. You haven't. What's happening now is exactly the kind of setup that disciplined investors wait for. Not because you can time the exact moment something breaks, but because the probability distribution has shifted in your favor. Let me explain what I mean by that. When you buy an asset that's out of favor, that's misunderstood by the mainstream, that's trading below its intrinsic value, you're essentially making a probabilistic bet. You're saying, I believe the odds favor this asset appreciating over time, even if I can't predict the exact path. The frustration comes when nothing happens, when the price stays flat, when everyone else seems to be making money in other markets. But that's not how long-term investing works. The gains come when the consensus shifts, when the data forces people to reassess, when scarcity becomes undeniable. What you're seeing now in the inventory data is a signal that the consensus might be starting to crack. Does that mean the price is going to explode tomorrow? No. Markets don't move on a schedule. But it does mean that the fundamental case you believed in when you first bought silver is becoming harder to ignore. Your job now isn't to do anything dramatic. It's to stay patient, to stay informed, to avoid getting shaken up by short-term volatility. The setup is in place. The hard part is waiting for the market to recognize it. If you've been watching this market from the sidelines, if you've been curious about precious metals but haven't taken a position, you're probably asking yourself whether it's too late. It's not. Here's the thing about assets that are still in the early stages of a fundamental shift. The best entry points aren't always at the very bottom. Sometimes they come after the trend has started to confirm itself, after the risk of being completely wrong has diminished. You don't need to catch the exact low to benefit from a multi-year move. What you need is conviction in the thesis and discipline in your execution. So what should you do? Start by educating yourself. Understand what silver is, how it's produced, where it's used, and why it matters in the current monetary environment. Don't rely on headlines or YouTube thumbnails. Do the actual work. Then think about position sizing. This isn't an all or nothing decision. You don't need to bet your entire portfolio on one asset. Precious metals should be a component of a diversified strategy, not the entirety of it. Consider starting with a small allocation, something that wouldn't devastate you if you're wrong, but something meaningful enough that you'd benefit if you're right. 5%, 10%, whatever fits your risk tolerance and financial situation. And be prepared for volatility. Silver isn't a stable asset. It moves, sometimes violently. If you can't handle seeing your position down 20% in a correction, you're going to make emotional decisions at the worst possible time. The people who do well in markets like this are the ones who understand what they own and why they own it, not the ones who chase momentum and panic at the first pullback. Let's talk about why markets behave the way they do, especially in situations like this. Most people enter a market when it feels safe, when prices are rising, when everyone is talking about it, when the narrative is obvious. That's exactly when risk is highest. The best opportunities come when things feel uncertain, when the narrative is unclear, when holding an asset requires independent thought and patience. Right now, silver is still outside the mainstream conversation. It's not trending on social media. It's not the lead story on financial networks. It's not the thing your neighbors are talking about at dinner parties. That's actually a positive sign. It means we're still early in the cycle. It means the majority of capital that will eventually flow into this market hasn't arrived yet. But here's what happens when the setup is this clear. Smart money moves first, not dramatically, not all at once, but methodically. They accumulate when no one is paying attention. They build positions when sentiment is neutral or negative. Then something changes. Maybe it's a geopolitical event. Maybe it's an inflation print that shocks people. Maybe it's a policy shift from a central bank. Whatever the catalyst, the narrative shifts. And that's when the broader market wakes up. Retail investors start asking questions. Financial advisors start recommending allocations. Media coverage increases. Momentum builds. By the time it's obvious to everyone, the easy gains have already been made. If you wait for certainty, you're going to pay a premium. That's how markets work. That's how they've always worked. The question you need to ask yourself is this: do you want to be early, or do you want to be comfortable? Let me be very clear about what you should not do in response to this information. Don't panic buy. Don't rush into a position without understanding what you're doing. Don't over-leverage. And don't assume that a 15% inventory decline means the price is going to double next week. Markets don't work that way. Yes, the setup's compelling. Yes, the fundamentals are strong. But that doesn't mean you can ignore risk management or basic investment principles. Don't put money into silver that you might need in 6 months. Don't borrow to buy it. Don't liquidate your entire portfolio to go all in on one thesis. That's not investing. That's gambling. Also, be very careful about who you listen to. There are people online who will use moments like this to sell fear, to push products, to inflate their own importance. They'll show you charts that go vertical. They'll tell you this is your last chance. They'll make it sound like if you don't act immediately, you'll miss out forever. Ignore them. Good analysis doesn't need hype. It doesn't need manipulation. It stands on its own. Your job is to think independently, to evaluate information critically, and to make decisions based on your own financial situation and risk tolerance, not because someone on the internet told you to. What we're witnessing isn't just about silver. It's about a broader shift in how people think about money, value, and risk. For decades, the global financial system has operated on a framework of fiat currency, fractional reserve banking, and central bank intervention. It's worked, in the sense that it's created enormous wealth and facilitated trade on a scale never seen before in human history. But it's also created vulnerabilities. When you expand the money supply at the rate we've seen, when you suppress interest rates for this long, when you accumulate debt at these levels, you create imbalances that eventually need to be resolved. We're in the early stages of that resolution. It's not going to happen overnight. It's not going to be a single catastrophic event. But over the next decade, we're going to see adjustments, currency volatility, inflation that persists longer than central banks expect, asset price dislocations. And in that environment, the assets that protect purchasing power that aren't tied to the performance of the existing financial system become critically important. Silver is one of those assets. Not the only one, but one of the most accessible, most liquid, and most fundamentally undervalued. If you understand this, if you internalize the bigger picture, the short-term noise becomes irrelevant. The hardest part of navigating markets isn't finding information. It's managing your own psychology. Fear and greed drive most people's decisions. They buy when they should sell. They sell when they should buy. They abandon good strategies because they don't see immediate results. Investors who succeed long-term are the ones who can separate emotion from analysis. They have a thesis. They test it. They refine it. And they stick with it unless the facts change. They don't check prices every day. They don't react to headlines. They don't let volatility dictate their behavior. This is especially important in markets like precious metals, where sentiment can shift violently and prices can swing 20% in a month. If you can't handle that, if you need stability and predictability, this might not be the right asset for you, and that's okay. Not every investment is right for every person. But if you can handle volatility, if you can think in terms of years instead of weeks, if you can focus on fundamentals instead of price action, this kind of setup offers asymmetric opportunity. The risk of being wrong is limited. The potential reward, if you're right, is significant. That's the kind of trade-disciplined investors look for. So where do we go from here? Honestly, I don't know. No one does. What I can tell you is what to watch, what to pay attention to, what signals matter. Keep an eye on inventory levels. If they continue to decline, if the drawdowns accelerate, that's confirmation that the supply situation is tightening. Watch industrial demand data, especially in solar and electronics. If those sectors continue to grow, if silver consumption from industry keeps rising, that puts more pressure on available supply. Monitor central bank policy. If inflation proves more persistent than expected, if they're forced to keep rates lower than they'd like, if currency debasement continues, that strengthens the monetary case for hard assets. And pay attention to investment flows. If institutional money starts moving into precious metals, if ETFs start seeing sustained inflows, if sovereign wealth funds increase allocations, that's the early signal that the broader market is waking up. None of these things happen in isolation. They're all connected. They feed off each other. Your job isn't to predict which domino falls first. It's to understand the structure, to position yourself appropriately, and to stay patient while the pieces move. Let me bring this back to where we started. A 15% decline in silver reserves isn't just a data point. It's a symptom of a much larger story. A story about supply constraints, structural demand, monetary instability, and a system that's been running on borrowed time for longer than most people realize. If you've been paying attention, if you've been doing the work, you already knew this was coming. Maybe not the exact timing, maybe not the specific catalyst, but you knew the setup was building. What happens next depends on how you respond. You can treat this like every other piece of financial news, something to scroll past and forget. Or you can recognize it for what it is, a moment where preparation meets opportunity. The people who do well in the coming years won't be the ones who react to headlines. They'll be the ones who understood the fundamentals, who positioned themselves thoughtfully, and who had the discipline to stay the course when everyone else was distracted. This isn't about getting rich quick. It's about preserving and growing wealth in an environment where traditional strategies might not work the way they used to. Stay informed, stay disciplined, and stay focused on what actually matters. The setup is complete. Now we wait for the market to do what markets do. Thanks for watching.